Plus, we just had a headline from bond fund manager Pimco, not just any bond fund manager, but the biggest one in the world. That company boosted its U.S. growth forecast for the next year on what it calls massive stimulus, something we've been discussing here. Let's hash it out on the close. Michael Gurka is founding partner at BruinHill Partners. He joins us from the CME Group in Chicago. And here with us in New York, Michael Aronstein, president, CEO, and portfolio manager at Marketfield Asset Management and chief investment strategist at Oscar Grusin Company, and probably a number of other impressive titles. But the most important thing is that
when you're old.
Your fund is outperforming
gather titles.
Its peers. Let me ask you first of all about Pimco's forecast for 3.5% at the top growth in the fourth quarter next year. I mean, you have been more bullish on this economy than a lot of people, especially during the rough periods that we've had, the bad economic data. Are they finally catching up to your view?
Well, I like to think so. Pimco is a big fixed income shop, and this has been almost an unprecedented period of volatility for fixed income markets, and the sort of volatility that results in losses, not gains. And so they have to say something from an institutional standpoint to address the concerns of their customers. They've had fairly abnormal results over the past 30 days, I would guess, in their funds. Most bond managers have. So it's hard when they're used to being out every day with a comment about the world. So it's very hard to ignore this and say, well, the bond market shouldn't be doing this because there's a new normal and the economy's hardly growing. And
Mike, they still say, Mohamed El-Erian, the new normal is still here, but they talk about policymakers, they're just kicking the can down the road. I mean, do you agree that the new normal is somewhere out there?
No, I've said this for a long time. Every cycle is unique in the specific characteristics of the cycle. We've never had a national housing collapse and an explosion the way we did in the mortgage derivatives market in 2008. That's because those markets weren't the center of speculation for the past 100 years. But each cycle has its own characteristics. But to say that this one is abnormal in a way that distinguishes it from the cyclical nature of our economy, I think is just wrong. But it's proven to be a great marketing slogan.
Let me just ask you, I know we have to get to the bell and the closing numbers, but the 10-year yield has gone up incredibly over the past few days, over the past few weeks. Is it your view that is because other people are catching on to global growth that is ahead of expectations? Are people getting more optimistic? Is that why?
No, it's hard. You really have to be careful about generalizing about the motivations of people acting in markets to try to.
It's very difficult. As a former markets reporter, I can tell you it's tough to find the reasons for these moves, but it's been an incredible move.
Yeah, and it's been even more incredible sort of in the intermediate part of the curve, and shocking to people, and it shows that it really is a structural aspect. When people are confronted with markets that move more than they should based on the news flow, which the bond market started doing, they don't rationalize. They don't think about it very much. They just react. It's, get me out and send me the bill later. And that tends to be the response to fast markets. There's not as much sort of detached, thoughtful calculation about what's going on in the global economy, because frankly, very few people have any clue as to the prospects for these global macro forces, at least to the extent that clue would mean something in terms of investing.
I want to bring in Michael Gurka. Michael, you're out there in Chicago at the CME Group. Interesting, we're kind of talking here in studio about what Zora just had to say about equity outflows, that we're still seeing money pull out of equities despite what we're hearing from a lot of folks about improving fundamentals, improving expectations for 2011. Does any of it make sense? What's the tone on the floor? Are people getting more upbeat in your view?
Well, they are, because the anticipation is that the equity markets are actually going to do very well in 2011 because of clean balance sheets and of the sort. And of course, the housing scenario is the dimmer there. But with the employment picture only maybe getting better, somewhere down the line, there's more optimism. One thing you have to put into the formula there is that, only 40% of the global listed equities out there are U.S. So there's a lot more choices and breadth around the globe with foreign equities, and also Asia as an example being, say, Korea and, of course, China are starting to see a lot more interest because of the returns they're generating on a global scenario. So right now, I am not surprised, not just from sovereign wealth scenarios, of why global equities will continue, and being non-U.S. that is, of getting more of an asset allocation here. And also, with the volatility picking up in the bond market, eventually what's going to happen is I think that non-U.S. equities are going to be a big benefactor of that, because it's a much better risk trade than, say, the commodity space, where a lot of people feel like they're buying the highs.
Hey, you know what? We talked with Jack Bogle. He's the founder of Vanguard, earlier today on Bloomberg Television, and he kind of addressed some of what's going on in corporate America and the outlook for the equity market and that new normal or so on. Let's listen to this.
We've come kind of back to normalcy, if you will, in the stock market. The next 10 years, however, we're starting at a better base. The yield is 2%. That's not high, but it's double 1%. And I think we should be able to get decent earnings growth over the next decade, maybe 6-7%, because corporate earnings should grow at the rate of America.
Mike, you kind of agree with that? I mean, that outlook here.
Yeah, absolutely. I think.
Or even better.
It might be better. We've just been through the worst 10-year period in more than a century in the U.S. stock market, and it's got people deciding that, well, now stocks are no longer a buy and hold asset. They're no longer a core holding to build wealth. And I think we're entering a period where the buy and hold strategy probably is the way to approach equity investing and investing in general, and just to ignore all the noise that's driving people mad.
Do you find it kind of surprising that we continue to see equity outflows?
Very surprising. It's part and parcel of the mythology that people have adopted now, that the U.S. can't grow, that we're an impaired society, that equities, now that they've been a terrible place to have money for 10 years, that's proven that they're going to be a terrible place for the next 10, which is the way people tend to reason by extrapolation, which in the investment world doesn't work. Once it becomes generally accepted that a past hypothesis is proven out, that's not a prediction of the future. All that means is that people have already acted on that hypothesis, which means that the opposite is more likely. And that's why investing is not instinctively kind of it's not a natural aspect of human response.
Michael, I want to go back to something you were talking about the drubbing that Pimco probably got over the past month. And indeed, I think we have a chart of the total return fund. That's the biggest bond fund. According to Bloomberg data, the fund lost about $6 billion in November. You're looking, though, at the past 30 days. That looks up, but I'm pretty sure it's down, so I'm not quite sure if that's the right one, but it actually saw the first outflows in 2 years from that particular fund. Do you think that these equity inflows will start once we start to see more significant bond outflows, and once you start to see, and do you think we're going to continue to see yields continue to push up?
Well, I think at the long end of I'll answer these kind of backwards.
Sorry.
At the long end of the curve, I think the 30-year is not far from representing a reasonable value. So I don't think there's a lot more risk back there. The shape of the yield curve, it may begin to flatten as people realize that the economy is on a normal or even better than normal recovery path. In terms of the flows from bonds back to equities on the part of the investing public, that's a process that's going to take years. People respond very, very slowly to these things. And I think the big shock to people now is they were in bonds because everybody said, well, they don't have the volatility of equities. And all of a sudden, we've had an episode of the highest bond volatility, at least in my lifetime. And people are looking at the fluctuations and the capital loss and saying, maybe these aren't exactly the safest place to be. And a 2% coupon perhaps is not. That's not what I need to live on.
I want to kind of shift the discussion a little bit, because we are going to talk to Austin Goolsbee in just a moment. And Michael Gurka, I want to get your take, the floor's take on the tax compromise. Granted, you guys are driving dump trucks full of cash home every night, so I'm sure you're for extending all of the tax breaks. But what would you ask, Austin, if you had a chance?
Well, I think one thing the market does very well is it uses the barometer mechanism very quickly. And I think there was a conclusion made mostly in the trading community weeks and weeks ago about where this was going to end up. And I think that fact that there were concessions made off of an election, it should be no surprise. Now, this could go 11th hour, or it could actually not happen at all. filibuster, whatever. But right now, at least, I think the volatility in the bond market is the greatest representative of why we're seeing what it is. And I think that's very positive for equities.